Good afternoon, everybody. This is Jeff Scott. Yes, I'm back. I'm busy, so hard to do these every week, but I had some time this weekend, so I thought I would do one of my reports. This is January 31st, 2016, and I've entitled it Oversold Bounce or Something More. And of course, as I noticed right away, I can't spell, so we just fix that. So in case anyone ever looks at it, they can't say that I don't know how to spell. All right. Oversold bounce or something more. Disclaimer, this is for education purposes only. Anything recommendations they're making this for education, not investment advice. I'm a doctor, not a broker. I am not affiliated with any software vendors or trading companies. I pay for everything I use, and trading involves risk, and you alone are solely responsible for any decisions that you make. I've really narrowed my guru slides down to two themes. The theme on the left is CanSlim, introduced by O'Neill, made better by Rallies and Catcher, and made electronic long before investors.com existed by HGSI, and then powered with Ian Woodward and Ron Brown. That's where I do much of my work, and I intersect that with the work of John Person, who has a lot of similarities, top-down approach, has some great signals built into Thinkorswim and available for other packages as well. He's an author, trader, and become a good friend of mine. Here's a couple of his more recent books. There's John, and I merge those two styles together to make my trades, and I use the position sizing money management as taught by Van Tharp, and add a little spice to my trading with things I've learned from my friend George Lee. I have many programs. I purposely close my desktop or hide my desktop so you don't get caught up by how many things I've wasted money on, and believe me, I've wasted money on tons. Just ask my wife. But all I really need to trade is my real-time trading platforms, and I use TradeStation or Thinkorswim. I find Genesis a nice to have but not necessary to have. And then for my analysis, I use HGSI and EdgeRater, and then I use my favorite seasonality programs. So let's take a look at the week that just ended. Here's a sector screen for Friday afternoon at end of day, and one could see that despite the high-profile blow-up by Amazon, although if you bought it overnight at $5.50, you would have made $36 on the day. So big bounce off the bottom, cut its losses in half. But you could see mostly green out there, as it was a very strong day on the market. Here's some Thinkorswim shots of the major markets. So I've got the E-minis, the NQs, and the YMs at the top, the TFs, the Russell futures there, the VX, and the dollar on the bottom. So I like to get a sense of where we are compared to the past. And we had a very profound breakdown in all the major indices, but Friday we had a big bounce, and you could see the little arrows coming in, which are PPS buy signals that look like they came in across the board on the markets. The VIX peaked a couple weeks ago and has been coming down, but it's still elevated compared to what low is. And the dollar also had a buy signal on Friday. Sure that wasn't hurt by the Japanese yen being devalued. So clearly we are in buy signals now in the major indices with the VIX heading down. But the question is this a bounce? Is this a change in the market overall? And we'll talk more about that as we go. On the weekly, some interesting things I saw where we pretty much on the E-minis took out the 2013 lows, or pullback here. I can't say the lows because it moved up lower than that at the beginning of the year. But we sort of held at this level, almost got down to the 200 weekly moving average, which is the 1,000 daily averages. You can see the NASDAQ pull back, not as deep compared to the prior as the S&P. The Dow broke below the 200, got above it on the weekly. The Russell, the weakest of the bunch, had a nice week this past week after a big hammer the prior week. Still struggling to get above the 200. And on the weekly, you can see the VIX, as I said, is still elevated, although not nearly as high as it was just a week or two ago. And the dollar kind of going sideways over the last several months. I like Genesis charts. They actually now offer a black chart. And one thing I did notice is that you can notice that the advanced decline lines across the board started picking up this week. It's the blue crossing over the dashed pinks is the individual. Actually, you can't see the moving average. The pink is the advanced decline line, and you can't see it well, but suffice it to say that in most markets and moved above its moving average, showing that advances versus decliners was improving, as was OBV on the weekly. Now, a couple somber things. And what worries me is interest rates fell last week down to less than 2. I think it's about 1.93, I believe it closed. That's important because what I found over the past couple of years, when the interest rates drop below 2, that's sort of a statement that the economy is having issues. Fed raised at the end of the year. A lot of people think that was a mistake. The interest rates are going down ever since then, despite the fact that the Fed raised. What does that tell us about the economy? Falling rates are good for REITs, MLPs, utilities, dividend payers, and some home builders. We saw some of that this weekend. If you look at the AD line, it's hard to see, but the white is the AD line, the yellow is the spiders, and you can see that on the weekly we turned up this week, and on the daily we turned up as well. If you look at market participation, we blew through the 2014 and the 2015 lows in the number of stocks trading above their 200-day moving average. We got down really close. We got down the lowest we have since 2009. One looks at the number of stocks trading above the 40-day SMA, you can see we had a big rally off the lows, but we got, again, extremely oversold with this most recent pullback. Canaries in the coal mine, despite Amazon blowing up on Friday, Apple being down for the year significantly, and Netflix pulling back. The Canaries actually held their own this week, and you can see on the week they were relatively flat despite some big blowouts. So holding their own at the Canaries, but as you can see, they are less than the 200-day moving average. Before I forget to tell you about it, we had a very important signal come on Friday. And you can see down here, this window is the OBV. That's calculated on whatever index or stock I'm looking at. But you'll also notice a series of brown and green bars. The green bars represent Eurekas. The brown bars represent, or red bars, Phoenixes. The Eureka is sort of the HGSI version of the O'Neill follow-through day, and it's one of the only programs I've ever seen that paints it on the chart. This just gives me an idea with 2 Eurekas in a row after a big full pullback and after a bingo. That suggests that maybe this rally may have a little bit of steam to go. Again, more on that later. Now, this is sort of the scary slide in that the selling power from Lowry continues to be massively above the buying power. And I would expect a crossover if and when we had a market rally. We haven't had a crossover where the selling is below the buying pressure. We haven't crossed back since the middle of the summer. It did go sideways for the week and not get any further apart. But this is bothersome and suggests to me that perhaps we've got continued weakness to come, although maybe not this coming week. Market thoughts. Markets reached the most oversold level since 2009, and we've gotten our bounce. We are still in a weekly downtrend and likely in the setting of a market top. I do believe that we will have a bear market, whether we're in the last couple of innings of the bull and we run back up to retest last summer highs, or we are in the late stages of the bull, or excuse me, early stages of the bear. Time will tell. I'm playing this as a bear market rally, though. I'm watching my resistance levels, tight stops, taking profits quickly. There was strength in interest-sensitive stocks this week, utilities, rates, and high dividend payers. Also some technology and retail, apparel, and shoes. Be careful. This is not March 2009. March 2009, we saw a significant oversold bounce occurring at the end of a very marked downtrend in the major markets. This is not coming at the end of the bear and the beginning of the bull. This is coming probably near the end of the bull or at the beginning of the bear. Remember, stock patterns are cyclical. You want, when you get your buy signals, which we're getting some, is when you want to go long. You want to be short the market when the market rolls over. The reason why I spend so much time on what the market is doing is what I'm going to do is determined by where I see us. Yes, I feel like we've got some more room to go, but I feel like this is a retracement in a downtrend and not necessarily a new bull market. Know your news and EPS dates. Here's some of the major things. First Friday of the month, you know what that means, unemployment report coming out. A lot of energy and a number of other things coming out this week. So big news week, as well as a giant week for earnings. And as it says in my little quotations, it's a judgment call to hold stocks over earnings dates. It is bad judgment to not know when your stock's earnings date is scheduled. As usual, we'll do my market review, some top-down analysis, some bottoms-up studying, and look at the chart of the week. Speaking of charts of the week, I'll come back to it in a little while. I did pick one, which you can probably cheat and see what it is by the lower left-hand corner. Excellent. I'm just finishing my updates here. Let me just run this one, and I'll be right back. All right, let's take a look at the market, looking at John's indicators. I think I could show it best in TradeStation. So let me pull this up. What we're going to look at here is a couple of indicators that I look at on a regular basis to give me a sense of what the market is doing. And these indicators include John's PPS buy and sell signals, which are the green arrows and the red arrows. It includes Alexander Elder's impulse signal, which is the color of the price bar. He uses as a filter. When it's green, he can go long or hold, but he can't go short. When it's red, he can go short or hold, but he can't go long. And when it's blue, it doesn't give him any direction. I look at the MACD histogram. I look for divergence and convergence, which are usually seen as dots at the end of these bars. We'll see if we see any of those. The high jum's not in play because we're not near a top. And I look at multiple time frames, daily, weekly, and monthly. So let's take a look at, let's do the markets. Now we'll do the futures. Let's start with the E-minis. So a couple of things that I see here. The first thing is I see that we've now entered a buy signal on the E-minis on a daily. Interestingly, we're still in a sell signal on the weekly, but a buy signal on the monthly. So here's where those counter currents start to occur. On the daily, these green dots that came in over the last 8 days or so were a signal to me that we were getting extended, and in fact, they were signifying some MACD divergence. And you can see that the MACD histogram was starting to turn up while price was still going down. The green price bar, the green arrow, so a short-term buy signal, little mixed on the intermediate, the blue bar, and the red bar despite the buy signal. So short-term buy, longer-term a little bit more confusing. The net NQs, similar story, short-term buy signal, green bar, intermediate long-term still look like they're in a downtrend. Russell 2000, similar picture. Here's one of the challenges with MACD divergence. There is evidence of MACD divergence back here, yet the stock kept selling off. We're in a sell signal across the board on the Russell. We have gone to a green arrow in guessing how John's stuff works. If we trade up on Monday, I bet on TradeStation we will get a buy signal. Interestingly, on Thinkorswim, we did get a buy signal on the Russell futures on Friday. A little bit different algorithms. That's the YMs, the Dow, in a buy signal with the green bar, not so strong on the weekly and monthly. So to me, I look at this and I see short-term bounce, but the longer term, the jury is still out. Very quickly, let's look at materials. Short-term buy, some divergence on the weekly. Energy, short-term buy, weekly buy. Interestingly, so energy is already turned on the weekly. Finances, short-term buy coming in on Friday, Industrial, short-term buy. You can see the divergence coming in. Got evidence of the divergence on the weekly, but you still have a sell signal. Technology, whoops, wrong one. Short-term buy, monthly buy, weekly still in the sell. Staples is a strength here. Short-term, intermediate, and long-term buy, spring bars throughout. So of all the ones we've looked at so far, Staples look the best, and then energy. Okay. We can look at utilities. Also look quite strong. Staples, utilities, and energy. Healthcare. First one with the weekly sell signal. So healthcare has been lagging. And then discretionary, also in a daily sell signal. So energy, staples, utilities are where the strength is. All right, with that note, I usually jump back into the market. Now, it said staples was strong, so I actually have a workspace where I looked at all the stocks by sector. So let's look for staples. So here's staples, and let's rank them by net return for the week. See if there's anything here that jumps out at me. First thing is these are Friday returns. And you can see quite a few stocks in the consumer staples with 3% or more return. All right. That's done. Good. So first of all, and I'm not asking anybody else to make any comments. Thanks to those who gave me well wishes for today, my birthday. You'll notice this background picture, a true testament of a bull market that keeps on running is this guy in the middle here, Bruce Springsteen. Bruce is in his 60s. I was doing some work in New York on Wednesday, found out he was playing, was able to get some tickets. The guy's amazing. I just wish I had that energy now, and I hope to be somewhere close to where I'm at now, where he's at in 10 years. But what an inspiration watching Bruce Springsteen at the Garden. All right, let's go into Edge Raider. Hope I didn't just shut it down. I guess I did. Restart it. So in Edge Raider, I do a number of different scans on a regular basis. It takes a little bit of time, as you saw, to update. But I also have 20 years worth of data. If I didn't go with 20 years worth of data, the updates, I can assure you, would be much quicker. So let's do my favorites. Let's do the Hindenburg Omen. So the Hindenburg Omen, there's no reason why it should be positive right now because we're not in at a top. And the Hindenburg Omen occurs in the top of a major market, and it signals to me that the pros are selling their shares and running away, and we, the amateurs, are buying them. There's been no major tops or bear markets that have occurred without the Hindenburg firing. We saw a number of spurier signals last summer, a couple near the end of the year. Never really took one as a clear-cut signal. When I say clear-cut, I'll show you what I mean by clear-cut. Hold on a second. Take a quick look. Well, you can look at any index, but let's just look at the S&P 500. And let's change the view to one that actually has the Hindenburg in it. Now, one of the problems I have with the Hindenburg is there's been a change. And how the Hindenburg's been calculated. I've got one that's got both. Let's see which one this is. All right, this is using bar chart market indexes. Let me add an indicator. And since we changed our index source, it looks like the old ones were calculated using a source that is probably not the best source today, but the new source isn't necessarily working in the old days. We'll use the all NYC index. All right, so I'm plotting both types of Hindenburgs in this window. And when I say let me do one more step. I'm sorry. New window. Hindi, all NYSE. Okay. We're going to move this. We just put in there up. Perfect. All right, so now I should have two Hindenburg windows. You notice that we haven't seen many of them. Let's keep going. Let's go to 2009. Actually, 2007. One more second. Edit current view. View. Let's do 2005. Okay, that's good. Try a different one. Apologize for this. And so many changes in HGSI, I've got to figure out where I put everything. All right, I'm going to stop the chart tape for a second. I'm going to fix my chart and I'll be right back. Okay, I'm back. My problem was I was using the wrong index. It didn't go back far enough. So I want to go look at 2007. I've done this before, so those of you that are new, or this is good, and those who've seen it before, go to sleep. You can see in 2007, in June, we threw the first Hindenburg here. And that was the first one in a year. But what I've said before is spurious Hindenburg is not meaningful. Then we had a couple pop up here, still in June. So now I've got 3 occurring in a month. This was a signal to get out of the market, especially breaking below the 50. Now, a lot of people ignored that, and they did okay. We had 2 more signals here. So we're failing to break out to significant new highs. We're getting lots of Hindenburg signals. We're now in July, and then ultimately the market breaks, bounces, and goes back up eventually. Keep breaking. So 2007, you see the series of Hindenburgs that occurred before the market rolled over. But the market came back. Now we're into late 2007, and guess what we start to see again? Not really making significant new highs, stalling in the same area, and if you didn't get out here, then you hadn't heard of the Hindenburg, because this was a clear time to get out. Multiple Hindis, it broke below the 50, it broke below the 200, and had you been smart or aware and gotten out below, when you broke below the 200 here, at say 1485, may have been shaked out here, but ultimately the market dumped. And you can see now the 50-day moving average was resistance, where in the past it was support, and we continue to drive down, several hundred drop in the Dow. So you're looking for this flurry of Hindenburg signals. We failed at 200 here. What a perfect classic signal here. Shooting star, failed, and you go down and hit new lows. And now we're going to get to the bottom at the end of 2008. And here's March of 2009 when So let's look at where we are today and look for where the Hindenburgs are. We haven't seen the Hindenburg on this chart. Here's some in December, but really using HGSI as a data source, nary a Hindenburg signal. Now, within Edge Radar, you could see as well, no signals going back quite some time. So we had a couple in the summer of June. But I'm looking for a basket, several of these occurring, not just two, and we haven't seen it. What's most interesting about this report is that we now have more than 2% new highs. It's been since the beginning of January, the last time we saw over 2% new highs. And the new lows, which peaked at 42%, my God, January 20th have rapidly recovered to only about 1.5% new lows. To me, this was almost a stealthy move because while we're all worried about the market, all of a sudden the market had a big move. If I look at the market report in Edge Radar, and look at the Woody indicator where green is a buy signal or a long signal, you could see that the Woody indicator actually turned green on the 21st was a low in the market on the 22nd. And you can see we've had 1, 2, 3, 4, 5 or 6 straight days of a potential viable rally, at least according to the Woody indicator. And lastly, to give you an idea of how quick this move has happened, let's look at the S&P 1500 and do the buckets report. This is looking at the number of stocks in the S&P 1500 above or below their Bollinger Bands, looking above or below the midline, and then putting them into different deciles. I use this report to get a sense of the market. And like everything else, I'm really looking for the market extremes because the place that I find it easiest to make money to the long side or to the short side is playing those extremes of the marketplace. So we should be almost done. I'll stop this for a second while we wait. I was almost shocked when I saw this weekend. We now have nearly 2/3 of the stocks are trading above the midline of their Bollinger Bands. That's a pretty bullish distribution. 14% trading above their Bollinger Band. Now, we could actually break out the market and see which stocks are in that category. What's interesting is, let's just go back one day. We're totally flipped 68% a day earlier, 77, 73, 88, 82. Go back to that 21st and the 20th, you had pretty profound numbers if you look at number of stocks trading below the midline on the Bollinger Band. Didn't have a huge number of stocks trading below the Bollinger Band since back here on the 13th when 45% of the stocks were there. So we got to pretty pronounced lows, but the market's actually been moving up in general over the last week, a little bit longer. All right. Clean this up a little bit. Let's go into HGSI. Let's go into Woodward and Brown user groups. Let's look at major market index, major markets plus, and let's go into the top-down view. Top-down view is price and volume. It really puts most of the weight on Friday, a little bit of weight on the last week, and just a teeny bit of weight over the last 3 weeks. Strength of the market. This is great if you're long the market to see the small stocks and mid caps come up to the top, especially here at the HGSI stocks. This is despite weakness in biotech and the large stocks at the NASDAQ 100, S&P 500, S&P 100 being laggards. If I look at a 5-day performance, the gold miners were up 9.1%. We'll have to look at the chart, see if it's time to buy. In volatility and biotech, they're the leaders to the downside. Let's look at some of our favorites. Start with the S&P 500. So first thing I wanted to remind everybody that we did see a Eureka here. And a Eureka is a potential follow-through day. Seems bar, which is a bingo, which is a major dump of the market, that's a fairly positive signal and signals to me that we might see some upward movement for a while. Now let's just look at the pure price and volume chart. And you can see that we have 4 moving averages, an 8-day exponential magenta, and then 17 simple, 50 simple, 200 simple in green, blue, and red. So if I look at the S&P 500 and I look at a chart a little bit less than a year, deep dump here, the low of the market occurring on the 20th. Just to give you an idea how much of a move we've had off that bottom. It's been a pretty good move actually. From the bottom to the close, we've been up 7% from the low of the day to the close of the day on Friday. And I'd also like to point out, clear this off, we closed at the high of the day on Friday. That's the good news. Bad news is we're way below the 250-day moving averages. Can we get a run closer to 2,000 before we get into major resistance? Sure. I suspect at this point right here, which has sort of been a fulcrum of resistance and support in the past, is going to be a tough place to get through. And that looks like it's at about 1990. So what will also happen over the next 3 or 4 days as we work our way towards 1990, that 50 is going to come down further. So I'm going to look at that 50-day moving average as being a potential resistance area. And so my hope is to run up here, but then it wouldn't surprise me to see a little bit of backfilling. But we'll see where the market does. That's the S&P 500. All I can do is guess. The futures aren't open, and I don't have a crystal ball. Again, here's the Dow, big volume on Friday. Nice up move. It too has some resistance coming in overhead at some point from that 50, and it too has a line right about here as I've written it, where you might expect to see some resistance, which wouldn't surprise me if the 50 and this arrow come together, and that's where this rally will fall. NASDAQ Composite, broken record time. Somewhere in this range between those two bars is where I expect to get into resistance. The 50 will probably come down to the lower bar, so that's probably more likely where we get resistance. But even with that, that's another 6 or 7% potential move up from here. So what happens when you get way oversold? Now, we could fail at any time, but what would it take for me to be bullish? It would take us getting above the 200, seeing the 50 get above the 200, maybe retesting and then going higher. So I'm not bullish long term. I'm bullish short term with this bounce. And let's just look at the Russell, which has been the weak sister. Again, a bounce off the bottom, frankly, low of the day to the close, 8% move in 7 periods. So we've seen a very big move off the bottom, one that I suspect most of the people probably didn't trade, especially since we got from the low of the day to the top 4%. About half this move occurred on the bounce at the bottom day of the market. All right, let's take a quick look at transports, which have been weak and not supporting higher markets. Looks like the major indexes broke above the 17, lots of resistance ahead. And the utilities, which will probably look a whole lot different based upon the low interest rate environment. And you can see utilities getting to that area of a triple top or double top from the past. So utilities, as we said, probably the strongest sector right now, really breaking out. Is this something that continues, or is this just running up because of the fear and angst? Interesting, you go out to a weekly chart, and you could see these run up another 10%. Wouldn't surprise me. notice the difference in this chart in the major indexes in that my closing price is above all the major moving averages. I'm breaking above this level of resistance if I trade up on Friday, and that would probably take me up to here. So trade up on Monday rather. So utilities above their moving averages, unlike the rest of the indexes we looked at. Take a look at some of the other things that we follow closely. The dollar gapped up on Friday, closed midway in the range, then going sideways until otherwise proven. Slow uptrend. Again, more bullish than most of the indexes I showed you. The VIX came down quite a bit this week, but notice it's still way above what low is. And low of now is in the 8 to 12 range, and we're close to 20 right now. So the VIX perhaps has more room to fall. As we've talked about before, you make money going long when the VIX comes back to normal. You make money going short, the VIX trades up off of a bottom. And so we're hopefully going to continue to fall back if you still have long positions. Gold had a big week. Let's take a look at the gold spiders. You know, one of these days, gold is going to be a buy. To me, it's not going to be a buy until I get strong buy signals and a move above that 200-day moving average. I think we're close. I think that gold is becoming interesting looking here. I mean, I could see heads and shoulders in this. I can see all kinds of things here. Bottom line is, from my perspective, for gold to get interesting, I got to take that line out and then retest it. And then I want to be living in gold. Right now, it's like all the other moves. It moves up to the 50, up to the 200 rather, and it fails. Break above that trend line, and I might have some interest in gold. Right now, we still get a short pop of another 3 or 4%, but one of these days, gold's going to have a move. I've not been a gold bug. I'm not a gold bug, but I may be getting more interested, especially if we can take out that 200-day moving average and hold. Silver, not as much of a move as gold had this week. Silver bouncing along its bottoms. So, major indices show some strength. A lot of movement up over the last 4 or 5 days. Is this a quick run up to a failure, or is this the start of something new? I go back to that S&P 500. Let's look at the 1500. That's more of a nice story of the market. I don't know how to do this with HGSI. Let's see what happens. I mean, this is a market, and I'm not the one to draw an elliptical. I'm just showing you that does this not look like a market that's rolling over, following that elliptical down? I'm concerned about this market. I think that it wouldn't surprise me again for us to bounce up and get somewhere between that 50 and 200-day moving average and retest. But I expect a failure and another move down. I might be wrong, and if I'm wrong, I'll adjust my philosophy, but I have to look at what I believe, and that means taking tight stops, small positions, and taking profits off right away. Let's look at industry groups to see if anything is standing out. 2-day forces up. I should have quite a few with what we had on Friday. Interestingly, no to the top. It's down, I'm sorry. So we have 96 industries, and I don't want index. I got to get rid of that one. Hold on a second. That is just a index of the indexes and not really helpful to me. I'll do that. That one, I just hit the delete key. So let's see the things that are moving. So we've got semis, some energy, interestingly, banks, energy services. Now this is, remember, this is a very short-term momentum indicator. Semiconductors, I mentioned some technology. Let's take a quick look and see if there are any of these that we might want to put to our buy list. We'll go to my busy chart. What do I see here? Let me type this up a little bit. I see a stock that's been an uptrend below the 50 at a kahuna and a pocket pivot on Friday, turning gray up here. Don't like the earnings per share growth, which are going down. I'm going to skip. Intel Corporation, pullback, skip. Skyworks, beaten up. Micron, beaten up. Cirrus Logic. This one's breaking out. I don't know if there's some acquisition story here. Don't love the earnings per share shrinkage. There must have been something here that stood out that I liked. And none of these made it my big list. There are other technology stocks I liked more. SanDisk, some of these stocks have hit, pull back to major support and running up. I don't like any of these as a short-term buy, especially when I think the market is ripe to roll over again. I don't want to buy things that don't look like they have much momentum. Oil exploration, we talked about energy having strength. These can all be ugly, ugly, ugly charts, but are any of them showing anything interesting? So you're going to notice a couple things. You're going to notice that most of them are below the 200-day moving average, but they've had a nice little move off the bottom, sort of coinciding with that market move over the last couple of weeks. Some of these, like Occidental, pay a pretty tasty dividend here. It's 4.4%. But compared to their long-term pricing power, this PE of 68 trailing 12 months, it's kind of frightening. So here's Occidental, ConocoPhillips, they all got the same chart pattern. They all pay a dividend. If you believe that energy is going back up someday, then you might want to buy and start to stockpile some of these that have been beaten up pretty hard. And there's so many different choices here. I have a small position in Marathon, which is bouncing off the bottom, pays a 2% dividend. Apache's been a good one over the years, pays a 2.4% dividend. Not high growth stocks, these would be more doing some bottom fishing. But if energy goes up, these might be some that lead the way. Barron's had a thing this weekend about banks doing well. These are some of the regional banks, and the first one is one that Barron's recommended. I think that the regional banks have got pummeled of late for a couple of reasons. One reason is some of them carry debt on some of the fracking companies. There's a lot of concern that there might be defaults. They also aren't winning with the interest rates being so low. Here's U.S. Bancorp. It's kind of a technical story to me. It's coming off some bottoms, lots of resistance overhead. Could it run up a couple percent? Sure it can. Then you get the index right away. And I don't usually like buying things that are underperforming the index. First Merit looks a little bit better, breaking above the 200 days. Still don't like its earnings. Pays 3.5% dividend. BB&T. Again, on the same chart, which is deep pullback. Not a high growth stock breaking out to new highs by any means. So let's make sure I got this set up right. I do. REITs. I mentioned the REITs look good this week. A couple of these are ones that I was looking at. So here is a Federal Realty Investment Trust. If you want to find a better chart pattern, sort of a deep cup, handle potentially breaking out. I know I'm stretching that there. Kahuna's pocket pivots, mobile breakout from a squeeze and a 2.5% dividend. One of the things you got to look at, stock's $152. 2.5% of that is about $4 in dividends. Does it bring in $4? Just about $4 to cover their dividend. You don't want to buy stocks that are taking debt to pay the dividend. Warehouse is a paper company that became a REIT. Not my favorite, pays a 4.8%. Equinix, type of nice, slow and steady rise. Mobile breakout squeeze. Kahuna pays a 2.2% dividend. Great earnings, very expensive stock, but safe. Has been safe. The other ones that I liked been watching on some of these public storage stocks. Look at Sovereign self-storage is one of them. They're the ones that you go and you buy a box or a garage and you store stuff in because you have too much clutter for your condo or your new home like we have. Nice uptrend, pays a 3% dividend, nice earnings per share growth. So clearly there's some REITs that look pretty good compared to the other charts we've been looking at. Oil and gas services, despite energy being a problem in some ways, these guys really popped nicely this week, led by Schlumberger, who had some good earnings come out and had a nice move. Retook its 50. My target here is the 200-day moving average. Now, I haven't really prepared to look at this, but you notice ever since it broke through the 50 here, or the 200 rather, the 200 was probably support the whole way up, as you can see. Once it broke below the 200, it becomes resistance. And it broke below the 200 in late fall of 2014, and I have no reason to expect it to break above the 200 here. I do expect there's a fair chance it might run up a little bit more and get close to that 200 before it fails. Short-term move, tight stops. Halliburton, similar pattern. It has not yet broken above its 50, which might be some resistance. Helmer Campaign, Weatherford, all similar types of patterns. I'm playing Schlumberger. You might as well go with the best if you're going to go into this. Consumer finance. These are infrastructure software, rather. So Microsoft, have they remade this company successfully? Is this the new growth leader? Well, look at all the other charts we've shown you. A big gap up on Friday, retook its 50. No moving averages ahead of it. Everything looks green and blue. Earnings growth isn't so hot, pays a 2.6% dividend. Maybe its model of going to cloud-based distribution of Office and Windows 10 and recurring revenues, maybe it does make sense. Microsoft looks pretty interesting, although it's getting near where you expect a reversal. Palo Alto Networks have been the best, I think, of the security stocks. Huge weekly move up here from January 2014 until it broke in January 2016. But you have a run here. When you just look at the last 52 weeks, it was down 15% since the beginning of the year. But 52-week low is, before I say anything, let me just run it right here. So if we go back to January 20, we'll go here to the bottom. Late 2013 to the top, this puppy ran up 400% in 88 weeks. Since that time, to the bottom before it reversed this past week, it's given up 31%. This had been a big leader in the market. Is it done going down and time to go back up? Who knows? Nice move on Friday. I need to see more. Notice the break came in here. Did have a kahuna. I'm concerned about the level of resistance here, but to be fair, that's about 15% away. Don't like the earnings. Oracle, no. Fortinet, got to get above the 50. So everything we're looking at, except for, well, some of the REITs look like junk off the bottom. Consumer finance. Look at those numbers, 6%, 7% returns for Visa and MasterCard. Maybe this is a good place to go high. Here's Visa, pull back to the 50, had a kahuna, global breakup from the squeeze, Bible gap up, mostly green up above, makes money, pays a dinky dividend. Maybe it's a nice time to get back into Visa. I'm curious, it's got a monthly. And Visa's had a huge run since coming public. But maybe it's time to start thinking about Visa again. MasterCard, similar pattern, belt hold pattern. Kahuna, pocket pivot, way below its moving averages. I like Visa's look a little bit more. Capital One Finance, similar looking chart. Back. Telco carriers, these give a yield and some potential for growth. Verizon. Again, a pretty good looking chart breaking out here to recent highs. Pocket pivots galore, had some kahunas there. Everything looks green, no safe widow stock. AT&T, same story, trying to break out to a multi-month high. All green, pays a 5.3% dividend. So that might be a place to play. So lots of groups up to the top. Most of them look like junk off the bottom. If you look at stocks that have had positive force for 5 days, there's still 89 groups. And I point out, as I showed you earlier, we have seen a rather massive bounce off the bottom. If I look at 2-day down, I don't see any groups. That tells you that there's a lot of momentum to the upside right now. And 5-day downs, no surprise, healthcare, as we talked about, being one of the weakest, led down by biotech, specialty pharma, and generics. All right, what else do I want to do? So one of the things that I do with John's stuff is he has a pattern called a high close doji. And a high close doji, I don't want to go too detailed, but when I find a weekly high close doji and I see strong on balance value, I kind of get excited. So let's go into the scanner. And let's take a look at some high close dojis. Here's the IBD 50 from this week. And I've ran John's high close doji scan on it. You can see it was run yesterday. And these are the ones in the IBD 50 that came to the top. So let's take a couple seconds and look at them. On my charting platform, this is 15 minutes here. We're not going to worry about that today. Here's monthly, here's weekly, and here's daily. You notice I paint on my chart when earnings come out. I got another month. I got 30 days. I have some of my indicators that I call the dots, and the dots have 7 indicators. The top indicator, if there was one, was a bottom gap up, then becomes a pocket. Then is a pocket pivot. Robo breakout's the third. Squeeze is the fourth. PSAR color is the fifth. Green candle low, red candle high is the sixth. And the seventh and lowest dot is forced kahuna green or red. So let's look at Euronet worldwide. Here's how I look at my charts. This orange candle here is a high close doji. There was a doji within the last 2 or 3 days, and I closed above the high of that doji bar. This is a potential buy for me on Monday. If I look at that pattern, OBV is very strong. Here's the daily chart. I'm in a weekly and a daily buy. OBV is strong here. EEFT is an interesting looking chart. I passed on it because I thought it was getting extended. Although looking on the monthly, it's not far from all-time highs. LE is one that's been in a pretty steep pullback and looks pretty good as well. High close doji in a PPS weekly buy. OBV strong. PPS daily buy, although it's had a little bit of run since then, but from this day here up here is only about $4. OBV also strong. LE looks pretty good. GGAL, I think this is a Spanish bank or Brazilian bank or something. High close doji. It's in a daily buy and a weekly buy. Thought that looked okay. I did like Ross Stores. Now I passed on it because I'd rather buy something that's moving up off the bottom. This one's already had a nice little run, but Ross Stores also had a high close doji PPS buy signal on weekly and daily. Also looks interesting. What I do is I run scans on a big universe of stocks. And what I thought was interesting today, or this weekend, I limit my universe, price over 5, volume over 250,000 shares. Usually at the most you see 30 or 40 high close dojis. One of the reasons why I'm bullish on the next week is I've got 46 monthly high close dojis, which I never really looked at before. And then on my weekly high close dojis, where I usually have 40 or 50, I have nearly 400. So there's a lot of interesting stocks that I came up on my weekend review. Some of the stocks that I liked, let's take a look at. start and just go through the charts, and then I'll look at a couple things if necessary with John's stuff. So let's go to the user groups, buy watch, Abercrombie and Fitch, one of my retail stocks that looked interesting to me this week. Like many others, been in a serious downtrend. Got above the 50, has retested the 50, had a kahuna on Friday, mobile breakout out of the squeeze. Don't like its earnings per share coming up. Pays a 3% dividend, huge amount of demand. I like ANF. Google, nice uptrend, pull back to the 50. Everything is green. Had a kahuna on Thursday, a couple of pocket pivots held up well despite the demise of Amazon. The challenge is with Google, it's got earnings on Monday, so can't buy it till after earnings. AutoZone, O'Reilly, and the third one, I can't remember which one, all look like they're having a nice move back up, and we'll retest old highs. They're all expensive stocks. This one doesn't pay a dividend. Broke above the 50. Barrick Gold, as I mentioned, I'd like to see gold test and stay above the 200. American Barrick actually has broken above the 200. Nice move off the bottom. Of all the gold stocks, that look like the strongest one to me right now. Blackstone Mortgage, this is really not a growth story. This is a stock that pays a 10% dividend that's had a nice move off of its bottom. In fact, this week it was up 1.7% and does pay a huge dividend. Cal-Maine Foods, I hear more about egg issues related to chickens and various viruses. Sold off after good earnings, sort of put in a bottom here, tested it a couple times. Looks like it wants to go up. It's got some resistance above it to be concerned about. Capstead Mortgage, this was one I liked, pull back. Looks like it's broken back out. We'll go back and retest the 10.5 level. Why do I like it? It pays 11% dividend, but the stock drops $2. It takes you 2 years with the dividend to remake your $2 loss. Carter's, I think this is children's clothes. As I mentioned before, clothes and apparel, and shoes. Had a big uptrend, pulled back from 110 down to 84. Pretty big week. It actually broke above the 200. Looks like it's wants to go higher. Casey General Store. You go look at this one. This is one that I almost took as my stock of the week. The reason why I didn't take it was because it's a $120 stock. If I look at an HGSI, I see it pays a 0.7% dividend. It has decreasing earnings for next quarter, then it picks up the following quarter. Uptrend, pull back to the 50 with the kahuna at a pocket pivot. Eureka's on the market. If I go into HGSI, and I take a look at, all right, it's a trade station, I see a weekly high close doji, strong OBV, a weekly and a daily PPS buy signal. This was a stock that looked very compelling, and I like it a lot. The challenge I had with it was the price. Fix has not fired yet. The Fix to me looks like it's going to go higher, but I'm not going to jump into it until I see a momentum change, a kahuna or a PPS buy signal. Coresight Reality broke out. This is one that's like Cone that I presented before, because these are data centers. And the data centers, there's digital reality, there's Core, there's Cirrus One, all have similar patterns, pay a nice dividend, a nice growth story, and they'll probably grow as the cloud grows. Here's Cone. We've talked about this one before. Choppy, but an overall uptrend, pays a 3.4% dividend as well. Delta. I made a comment here once that I sell my Delta shares at 50 and buy them back at 40 or 45. I think it's time to buy them back. Great earnings per share growth and a strong industry group with great fundamentals going forward with cheap oil. Pulled back hard, had a reversal day on Friday. Here's the other one of the companies that does the data centers. This is digital reality. Dicom, this is a fallen leader. Let's go take a look at Dicom in TradeStation. This was an IBD 50 leader, which broke down below the 50. Had a kahuna on Friday. Looks to me like it wants to go higher. Still in a weekly sell, although it did have a daily high close doji. I would say not ready, but close on Daikon. Ellie Mae, this is one that I showed you on trade station indicators. I thought looked great. It looks great on the HGSI. Had kahunas earlier in the week, a pocket pivot on Friday, broke above the 200. Everything is green. This is as good a chart as I showed you. Ellie is one that's on my buy watch list for this week. Facebook broke out to new highs. You all know Geo Group is a REIT. This one is into correctional houses. Pays an 8.8% dividend. Bouncing around off its low. Had a couple of free kahunas in the last 7 days. Above the 50, might run higher. Does pay a nice dividend. G3, this is a bottom fishing apparel stock. Wasn't my final choice, but as I said, there were a lot of apparel stocks made my list. Headwaters is a building material stock. Deep pullback like .com. Bounced hard on Friday with a kahuna and a mobile breakout. Good earnings per share growth. Home Depot had fallen hard. Slowing earnings. Bounced off earlier in the week. Will probably go back and test its 50. Huntington Ingalls, they make aircraft carriers. I don't know why I picked this one. Great earnings per share growth coming in. Couple of kahunas. Has to break above the 50. Mobile breakout coming out of the squeeze. Ingram Micro, sort of perhaps good news for anybody that sells technology. They're a big technology distributor, and they were living on their 50. They had a nice move up on Friday with the market strength and a pocket pivot. Earnings coming back into the stock. Kinder Morgan, this was one of my energy thoughts. All these stocks that I'm listing here are stocks that have gone into my short list for this week for various reasons. I'm trying to point them out. Kinder Morgan is one of the ones that have been killed. It's actually up 10% on the year. It has moved up 4 points from its 52-week low. It's got horrible relative strength. It pays a 3% dividend yield. It's a midstream oil and gas. They just did some M&A activity. Let it get above the 50 before you go crazy. But if it breaks above the 50 and holds, I'll probably be adding to my position here. Lowe's Company, maybe a better buy point with a kahuna on Friday than Home Depot, a little bit stronger earnings coming in. Maxilinear, this was a great technology story. At the end of 15, that sold off. Had a kahuna on Friday, does get above the 50. Great earnings per share growth, which always gets me hot and bothered, so I'm watching that one. Mid-America, another REIT. I think I've talked about this one before. Nice lower left, upper right, steady Eddie. Pays a 3.5%. National Storages, I think that's another one of those you store it places. Yep, self-storage. This has been a hot group, just like the technology. Pulls back to the 50, good place to buy. Kahuna's mobile breakup from a squeeze, 4.6% of dividend. Neophotonics, this is not a great fundamental story looking at the earnings. This was a high flyer in this last quarter, going from 7.5 up to about 12. It pulled back to 8.5 and bounced. Just from a pure technical play, I'd like to see it get above the 50 before I get excited. Omega Protein, talking about technical plays. Here's one of my pullbacks to the 50 with the kahuna screens. Great earnings per share growth, doesn't pay a dividend. Not sure I like the business that they're in as far as being sexy and new, but I think the stock's at a place that might be a good place to buy and is likely to go higher. O'Reilly's been one of those expensive automotive stocks that doesn't pay a dividend. It looks like they're on another up move. Physicians Realty Trust, another REIT. This pays a 5.3% dividend. Huge earnings per share growth. Support that. Another REIT, RPT, breaking out with a mobile breakout from a kahuna from a squeeze on Friday. 4.9% dividend. What are they? Shopping centers. Rollins, building maintenance, pullback, broke above its moving averages. Surprisingly not in the squeeze. Kahuna's pocket pivots. Great earnings per share growth after this coming quarter. Next earnings not to May, small dividend. Schlumberger, we looked at already. Skechers, this is a shoe stock. Made a higher low here, had a kahuna. Great earnings per share growth, 2.5 times its PE ratio. Looks like it might want to go higher with strength coming into this group. Starbucks, here's your consumer staple story, or consumer discretionary rather. Uptrend, pull back to the 50, multiple kahunas, everything's green coming out of the squeeze. Take a look at it with the trade station setup that I use. Weekly buy, it's in a daily buy. OBB looks strong. Starbucks looks good. I like Starbucks here. Steve Madden, another shoe story coming off the bottom. Can it run up to that 200-day moving average? It's got earnings per share growth. Had a bunch of kahunas as it came off the bottom. Typical big move over the last 5 or 6 days. This one's up 5.3%. Supermicro, mainframe maker, broke above the 200, which I like to see. Had a kahuna on Friday, viable gap up. Earnings are slowing until the following quarter, does not pay a dividend. Terex had a big gap up. I don't know if they pre-announced or what. Let's see if we can figure that out. I don't think their earnings are out. Oh, somebody put in a bid for them. We'll skip that one. Toomey Holdings, retail play, going nowhere for months. Had a kahuna out of a squeeze, broke above the 50. Probably has about $1.50 to run because of that 200. I'd probably pass. Alta, been a great story for a long time. Is it ready to resume? Look at the nice uptrend on the weekly. You want to buy stocks like this on pullbacks. Pull back to the 50 at a PSA reversal on Friday at kahuna. Logo break up from a squeeze, everything turned green. This has been a big leader. It looks to me like it might want to resume. Under Armour was one of those broken down apparel retail shoes companies, and you could see it had earnings come out in a big gap up. Actually came up on my screen, so I was holding some calls. Actually bought a back ratio spread where I sold an at the money call and used that proceeds to buy 3-to-1 out of the money calls. And I'm now in the money on the trade, but we'll see what happens. I think it's getting close to resistance at that 200. And then Urban Outfitters, we'll come back to that. Zebra Technology, another stock in a deep downtrend. The thing I liked about it was it had that kahuna here. I'm not sure why I picked it. It doesn't look so good. Let's look at Urban Outfitters. Urban Outfitters is been around for a while, retail apparel for kids. It's in a huge downtrend from 46 down to 23. So it's fallen in half over since March of 2015. 5-day performance up 5.7%. Flat since the beginning of the year. It got my attention for a couple of reasons. Number one, it had a kahuna and pulled back to the 50 scan, coming out of a squeeze. Number two, if I look at the weekly, I see a stock that looks like it's bottomed. It's moved up now 2 weeks in a row, got above its 8-day exponential, had pocket pivots, logo break up from a squeeze on the weekly. So sometimes I like to buy stocks that I think are oversold and try and play the bounce. I don't take big positions. I don't give up big stops. So let's take a look at what I would do with Urban Outfitters. So, as you might guess, seeing those lines there, Urban Outfitters is my stock of the week. Caveats. It's in a downtrend. It's got bottoming tails. It's in a daily, actually a weekly new buy here. It's in a daily buy. OBV is moving up on the daily nicely. It's moving up on the weekly, but it still has to get above some resistance. High close doji. So my trade, let's go back into PowerPoint. First of all, charts of the week. These are an exercise of how I take trades, what I look for. They are not recommendations for you to take. Education purposes only. Trading, especially options, carry substantial risk. I do not warrant these trades. If they execute, I take them so I can discuss them. I'm doing this to educate, not to provide stock tips. So I already showed you why I like Urban Outfitters on the HGSI type chart. Clearly in a big downtrend. Looks to me like it's put in a bottom, and perhaps with this breaking above the 50, you can see the group line in gray going up. It will have a little bit of a run. I showed you what I liked on TradeStation. Here's my trade, closed at 22.80. Its high of the day was 22.92. So I'm putting a buy stop at 22.95. My stop is at 21.40, which means I'm risking $1.55 or 6.7%. And for $2,000 of risk capital, I'm buying 1,300 shares. My target is 24.25. My trading plan is this. If we trade above 22.95, I will go long on Monday. If we don't trade above 22.95 on Monday, I'm not going long, and I'll take my trade off. I don't leave it sitting there, so there'll be a buy stop. When I take the trade, I will immediately put a fail safe, so all I can lose is 6.7, barring a gap against me. The market opens down 300 points, I'm not going to get filled, I'm not going to take the trade. When I hit 24.50, I will take 650 or half of my shares up, and I will move my stop to break even. At some point, probably around 26, I will take another half of my position off, and I'll switch it to a trailing stop until I get taken out by my trail, or I get a weekly person PPS signal, sell signal. That's how I plan on trading it. Now, I might decide to go with options. This is from Options Pro, and what I'm looking at are various trades. So for example, if I bought 100 shares of stock, all I can lose is $2,288 and I have infinite gain. All right, but I got to spend a lot of money to buy that stock. I could buy a call that's a $23 call. That means once it gets to $23 and a penny, it's worth a penny. I can give myself a month to get there. February 19th, I could look at March calls, and I'm going to pay probably 75 cents for that call. So for one call controls 100 shares, that's going to cost me $75 to control 100 shares. So on one trade, it's cost me $2,288 to control 100 shares. If I bought the calls, it cost me $75. The nice thing is, all I can lose is that $75, and I have infinite gain. So buying a call might make sense. I might do a bull call spread where I buy something and sell something, and I put the money in my pocket from selling the spread, and as long as the stock goes up, I will make an additional dollar, which is the difference between 23 and 24, minus whatever I got paid to take the spread. But I've really limited my profits here to $60. So I don't like that trade at all. How about a covered call? I sell a call and I reduce my costs, but that also limits my gain. I don't like that. What I like to do is either do a long call, long stock. How about a synthetic long? Let's say I sell a put at $23 and buy a call at $23. I have the exact same P&L curve as if I bought the stock, except I put $22.50 in my pocket. The most I can lose is $22.77, which is actually less than if I bought the stock, and my gain is So there are a number of things that I could do to take the same trade. I just put this here for demonstration purposes. So lastly, the PUG user group. If anybody has or interested in purchasing John's indicators and it has HGSI, you're welcome to join. There's no cost to join. Those that are members, John and I will be having dinner tonight and probably setting up a PUG meeting probably Thursday night this week or Wednesday night. See you sometime in Florida when I do my next meeting or I partner in one of John's meetings. You all have a great good night. Thank you. And careful out there. It may look pretty good right now, but we've moved up very quickly. And as I said, this may just be a bear market